Coming up today, stocks finish lower, the latest blockbuster AI deal, J Powell's bleak outlook on the economy, rising geopolitical tension, what could cause inflation to come back, robot umpires come to sports, and as the long-awaited market pullback finally arrived, it's an interesting day out there, guys. Let's go. And welcome back to the Daily Market Review, guys. We've got a bit of a rotation going on out there today. Utilities and energy perking up with the mega cap tech, AI trade, and some other hot stocks having a bit of a pullback out there today, like I'm about to show you in the charts. But stick with me because later on, I'm going to show you two industries nobody's really talking about that are actually ripping higher today. Could be the start of more to come. Plus, if you're interested in following my new $100,000 ETF portfolio, then later on in this video, I'll be answering 10 frequently asked questions so you know exactly what to expect when I open the doors this Thursday, right after market close. I'm super pumped to start this new portfolio soon. But first, let's just take a look at all the important things happening in the markets today. We just got news of another blockbuster AI deal. OpenAI, Oracle, and SoftBank announcing 5 new Stargate data centers, part of the huge Stargate project, which those companies have pledged to invest up to $400 billion over the next 3 years, with the full government backing to build out the infrastructure needed for artificial intelligence to grow as fast as it can. But the interesting thing is, the market's not really reacting. Oracle was actually down 4.3% in the regular session today, and just going to the 5-minute chart after hours here, we did initially get a perk up on that announcement, up 2%, but it's pretty much given back most of those gains. We're only up a meager 0.46% after hours. And so the market's having a rather muted response to what is normally enough to get things ripping higher, suggesting the market may be becoming a little numb, at least for the here and now, to these big AI headlines, as we have been getting quite a few. Plus, we're right in the thick of the worst performing 2-week period of the year, late September. And we have been getting a little bit of a divergence between the S&P 500 and the VIX. Looking back in history, when the VIX is up by more than 1.39 points in the past week, while the S&P is up more than 1.6% to an all-time high, typically we get a pullback over the next couple of weeks. In fact, in that scenario, we were only higher 3 weeks later, one other year, back in March 98. Not to mention the persistent concerns over valuation. After this amazing V-shaped recovery, no doubt many investors will be on edge for a pullback or correction. The market can quite often talk itself into doing that because we've really had a lack of any negative headlines for a little while now. Ever since the market digested and got over the tariff tantrum, it's really just been grinding higher on the back of momentum in the AI infrastructure trade. But there's still no signs of backwardation in the volatility term structure. The VIX is still relatively low, but it may have indeed found a floor around the low 14s there. And I am seeing plenty of bearish reversal signals across the market and some of the hottest names. We saw them last week in the MAGS ETF, mega cap tech, with big names like Tesla definitely looking a little stretched here in the short term, and some of the hottest smaller stocks as well, looking quite technically overbought in the short term here. Nuclear power company Oklo, fourth reversal signal. Quantum stocks really ripped up this last week. No doubt that's a strong momentum move, but could be vulnerable to a pullback or consolidation here. And the super hot AI infrastructure trade, led by companies like Iron, put in the fifth reversal signal, and some of these hot battery stocks as well, like Amprius Technologies, which are quite a bit above the 50-day VWAP. So, like I said last week, I wouldn't be surprised to see a bit of a pullback and consolidation this week. It doesn't mean the long-term trends are over, just means we've got a bit heated here in the short term, and some of these hot stocks and sectors could be due a breather, which is a healthy thing. But stick with me because later on I'll show you a forgotten hot sector that is actually perking up today, nowhere near as overbought as some of these other names, and also another beaten down sector that appears to be potentially making a comeback. I'll show you a few interesting ETFs you may not have even heard of before that are actually breaking out. But that's just the short-term technicals. Just stepping back a bit, looking at a bunch of different investment factors before we get into a little macro data. Definitely seen a comeback in IPOs. IPOs have definitely been having a few good months. Companies recently listed onto the market perking up, and of course large cap growth has been doing better versus the market, and of course there's plenty of room to catch up for small caps relative to the market. But what's really been leading this year has been the momentum investment factor, and that's not just in the States. In fact, we've got a really good, robust global equity bull market happening right now, with over 80% of international stock markets above their long-term 200-day moving average. And that's a good sign because it can stay there for multiple years. And just looking at the all-world index, excluding the States, the last few months we've made a clean breakout above 17-year highs, as a lot of European and Asian markets have gone nowhere for a decade and a half. Now they're breaking out. And so it's a great time to be a global momentum investor because it's not just international stock markets, We've also got cryptos and plenty of commodities breaking out on the upside with potentially a lot more room to run as a lot of these bull markets are quite young. And back in the States, I think small caps have a good chance to catch up to their large cap peers. We've got the Russell 2000 breaking out to all-time highs last week, but also on a valuation basis. Forward PE on the S&P 600 small cap index, 15.7. That's a next year earnings yield of 6.36%, well and truly above short-term bonds, and that gap could actually increase thanks to not only growing earnings in the small cap universe, but also the likely path of lower rates. Jay Powell gave a speech today actually describing rates as modestly restrictive. That's quite a dovish statement, suggesting rates are too high, and once again changing his tune on tariff as he had been forecasting them to bring us a healthy amount of inflation this year. He's watered that down once again today, saying tariff costs to consumers are later and less than expected, admitting at this stage they don't appear to be a major inflation factor. And that's because, as I've been arguing all year, the data simply doesn't support it. And I know this chart's a little blurry, but basically what it shows is the US government has collected about $190 billion in tariffs so far this year. You contrast that against the $456 billion they've collected in corporate income taxes and the massive $3.3 trillion they've collected in individual income taxes. And you scale that to the real economy. So even if every dollar of tariffs were passed straight through to the consumers, that's $190 billion against a $28 trillion economy. We're talking about a few tenths of a percent. Plus, a lot of tariffs fall on intermediate goods, where companies can absorb or spread the costs. So the impact of tariffs gets diluted across long supply chain. But can tariffs bite in specific categories? Yes. Certain imports can see price pressure. We've also seen the price of imports come down as importers negotiate with those exporters. We've seen that in Japanese vehicles, and just overall the amount of consumer goods being imported drop and supply chains getting rejigged. But overall, macro level inflation isn't being driven by tariff. This data supports that narrative is way overstated. The bottom line is tariffs are not a huge cost on Americans thus far, and by themselves are unlikely to push overall inflation meaningfully higher. I think we're still struggling with excess liquidity, but there could also be other risks to inflation that I'm going to show you later in this video, not coming from tariffs, but something else. So we very well could see a few more cuts over the coming months. We're hearing from a bunch of Fed speakers this week, and they're all jumping on board the rate cutting train. Once again, catching up to where the market's been for a while. Fed Fund futures strongly suggesting we're on a steady path down to 3% next year. And so if economic growth and corporate earnings hold up, that's going to be a huge tailwind for small cap stocks. But Jay Powell, the most influential man in finance, isn't talking up the economy, isn't feeling optimistic. In fact, he's preaching words of pessimism, pointing to a darkening economic picture, even saying stocks are fairly highly valued, which is not really a market he's supposed to influence. His mandate is the labor market, inflation, and interest rate, along with overlooking the banking system. So, I mean, he's been pretty wrong on inflation for a while now. I wonder if he's also wrong on his stock market call. No doubt there is plenty of weakness throughout the economy, but overall consumer spending is holding up. We saw that in retail sales last week, still growing 5% year over year. And just looking at market implied recession probability indicators, they're only averaging really low here at 20%. Credit spreads are very tight, very little premium over treasuries. They're not worried at all. Volatility in markets is really low. Of course, the stock market's pretty much sitting at all-time highs. The bond yield curve in a healthy state of contango. But for sure, there could be potential new risks just around the corner. Like I said, we haven't had any real big negative headlines for a while now. That's not going to last forever. Could actually be geopolitics coming back onto the scene like they did back in early 2022. As we've now got a changing policy stance from the US president towards what's happening in Eastern Europe, reversing a stance that some land would have to be conceded to resolve the conflict over there, coming out with a fiery post, and I think this is largely due to the attempts to resolve this last month in Alaska with a peace deal, literally rolling out the red carpet for the Russian leader, which he threw it all back in the president's face 2 days later with the biggest missile and drone bombardment they've done to date. He was given an off-ramp but didn't take it, and now we've got the US president saying they're going to continue supplying more military assets. Also trying to cut off revenue to Russia, putting the squeeze on them, how they finance this conflict. And so just looking on Polymarket, the odds that we were going to see a ceasefire shot up on that peace summit in Alaska, but quickly fell over and are now sitting at a very low 11% chance this year. And there's just been a new market created in the last day of a potential NATO and Russia military clash. Still quite low at 13%, but there's only 3 months left in this year. And so that could be a risk to the markets, along with potentially this as well, which I would say could still be a tail risk in Q1 next year. And that's probably adding to gold's rally of late, these geopolitical concerns, as they've kind of taken a back seat for a little while now. They can kind of just pop up out of nowhere. But as you guys know, I think gold, the commodity itself, is a little stretched here. What looks a lot better to me are gold and silver miners, as again, the mining industry is at all-time lows as a percentage of global equities, looking at market cap, now only 1%. And so who knows, we could see an oil shock, the biggest cost input into the economy, the biggest variable of inflation. And so who knows, it is possible we get a second wave of inflation, just like the 1970s after the oil shock they got back then. And so it may not be from tariffs, but rather oil popping up. And there's a look at a long-term 3-monthly chart of junior gold miners versus gold. Huge decade-long base here that may have found support and still hasn't even broken out of the base. So again, could be early days on miners outperforming. And we've really seen a bounce back with silver miners as well. Just looking at the junior silver mining ETF versus the silver ETF. Nice clean breakout there. And silver also benefits from the electrification of the world as well. Demand for electric vehicles and solar panels, potentially robotics as well. But it's not just precious metals. We've seen quite a few strong rallies in commodity-related sectors. Junior uranium miners also perking up here again today, whilst the stock market was down, and a big rip for platinum as well. Looking at the physical platinum ETF, up 3.8% today, breaking out to a fresh yearly high. And actually the best performing stock sectors today were the oil services ETF, up 2.7% on volume, taking out a multi-month high there. Similar deal for the oil and gas exploration ETF, starting to perk up here on volume. Similar story for natural gas, still hasn't broken out though, and we're starting to see a bit of activity in some of these other ETFs, like the North American Pipeline Fund, an ETF that invests in master limited partnerships. Bit of action recently in the global energy ETF, these big volume days. Looks like some big accumulation. And again, this is a sector that's kind of been really under discussed the last few months, as it's really been the Mag 7 and the AI trade. But again, we're seeing some signs of momentum develop. Here's another one, North American Natural Resources ETF, breaking out again today on volume, and a really interesting one you may not have heard of before. Also breaking out today, the Horizon Kinetics Inflation Beneficiaries Fund. Still quite small here at 1.3 billion AUM, but that just broke out to all-time highs. And just looking underneath the hood of this ETF and what it owns, a bunch of commodity-related stocks and even others like financial exchanges, infrastructure, and land REITs, as they're kind of inflation-protected assets, as they can have leases indexed to inflation, and a few other of these royalty companies as well. So I thought that was quite interesting, along with commodity-related countries like Brazil really performing well this past month, and just Latin America in general. This fund holding 40 companies across Latin America also outperforming. As I was saying before, we've got plenty of global momentum out there, and hence why I think it's a great time to start a global momentum strategy. With my new ETF portfolio service launching this Thursday, I thought I'd give you guys another quick slide deck today on 10 frequently asked questions, just so you know exactly what to expect when this service opens up in 2 days from now. And so the first question is, what would be the minimum account size I would run this strategy on? Well, like most strategies, I would probably want at least $10,000 to run this on. But of course, many brokers nowadays offer commission-free trading. So it's really up to the individual. But for me personally, 10,000 would be my minimum. And like I said, I'm actually running this strategy live with 100,000 US dollars of my own money. Question number 2, are US listed ETFs available to investors in all countries? Unfortunately, the answer is no, and I do apologize to my British and European friends, as unfortunately your government prevents you from investing in US listed ETFs, and their classic style of overregulation and overreach, causing more harm than good in my opinion. The only way UK and EU residents can invest in US listed ETFs is if you get classified as a professional investor, often needing a portfolio bigger than $500,000. The alternative is you could follow and find similar locally listed ETFs than the ones I'm investing in, but there will be times I'm investing in more exotic US listed ETFs that simply don't have something quite similar listed in the UK or Europe. And so again, it's unfortunate that UK and European governments block their residents from accessing the biggest ETF market in the world, with ETFs arguably the best building blocks of wealth. But for most other countries around the world, US listed ETFs are available. Question number 3, what types of ETFs will I be investing in? So only US listed long unleveraged ETFs. I won't be investing in any leveraged ETFs, no inverse ETFs, just plain vanilla long assets across every different asset class: stocks, bonds, commodities, cryptos, and even strategy funds, like that Inflation Beneficiaries Fund. That's the cool thing about modern day ETFs. We can now gain direct exposure to economic cycles in a purpose-built themed fund. And that's why I call US ETFs the gateway to the world, as there's literally over 4,000 US listed ETFs trading in New York now. Question number 4, can this strategy still perform well throughout a bear market? And so the answer is yes. It's built to survive first, perform second. And that's not to say there won't be any volatility or drawdowns, which we can typically see when markets transition from one regime to another, or one big theme ends and new themes emerge. That's when we usually can get a drawdown, but my strategy won't stick with underperforming assets. It'll always find the best performing assets no matter where they are in the world. And so the goal is to have shallower drawdowns and faster recoveries than any other single market by just buy and holding like the S&P 500 fund. It's not about predicting bottoms, but systematically stepping away from weakness and leaning into what's actually working. And so the goal is to outperform the major indices over time with less drawdown. Of course, there's no guarantees, but historically, using a diversified momentum strategy has shown to outperform over time. Question number 5, would I use leverage with my strategy? Well, I'm not. Like I said, my strategy holds the top 10 ETFs equally weighted. So that's 10% of my account in each ETF. Whenever I buy a new ETF, I put 10% of my current account value in that ETF. But if I was going to use leverage, I would just use a little bit, maybe 120, 130% max. Because just remember, leverage multiplies both gains and drawdowns. So it is definitely possible the strategy could have a 30% drawdown at some point if the market has a 40% drawdown or something. And so if you're levered up 130%, that 30% drawdown can become a 40% drawdown. I would only lever up if I thought I could handle a 40, even a 50% drawdown. But that's something you got to be very careful with. And for most people, I don't recommend it. Question number 6, will I be adding funds to my account each month? Dollar cost averaging, DCA. The answer is yes. Like all of my investment accounts, I contribute each month to it. And so for my ETF portfolio, I'll be contributing $1,000 per month. And that's because it's a great strategy. And the question is basically, why wouldn't I invest more into it? And that also helps deliver much smoother returns. And that's something I've done with my stock pick service by buying $500 of a new stock every Monday. And so even though I had a 22% drawdown in the tariff tantrum, there it is on the equity curve, which is a lot psychologically easier when you're dollar cost averaging. And that's because when prices are low, that allows you to buy more shares. And so it kind of smooths out the returns over time and makes it much easier to stay invested. Because this is the equity curve, but just going over to returns, the equity curve is a lot smoother than the returns. With my time-weighted returns now sitting at 46%. Sharpe ratio 1.41 with a beta less than the market, and now outperforming my benchmark, the Vanguard Small Cap Index Fund, which basically mirrors the Russell 2000 by a factor of more than 2. Small Cap Index up 19% since I started. My stock picks portfolio up 46%. And so I'll be doing the same thing with my ETF portfolio, dollar cost averaging each month to create that smooth equity curve. On to question number 7, are taxes a consideration? So yes, monthly rebalancing can realize capital gains depending on your jurisdiction. And in taxable accounts, some of those will be short-term gains. But the point of the strategy isn't tax minimization, it's return and risk control. And so if the process delivers excess returns and keeps me from being 100% tied to one market, that can more than offset the tax drag over time. And so I'm trading a bit more tax friction for global diversification and a rules-based tilt to strength, which historically is where the compounding comes from. Even after taxes, it's still better than buy and hold, which for a lot of people turns into buy and hope. That's not a strategy I'm comfortable with. And so this strategy is not just for retirement accounts. I'm actually trading my new ETF portfolio in a non-retirement account that I will have to pay tax on, and I still much prefer that than just buying and hoping with one fund, because any market can have a 50 or 70% drawdown, and in that scenario, you're not too worried about the tax bill. Question number 8, do I offer customer support? The answer is absolutely yes. I was taught from an early age, working at an investment bank, to always be client-driven, and that's something that stuck with me throughout all my career. I know I can only be successful if my clients are successful. So if you've got any problems, issues, or questions, anything at all, you can always reach out to me and I'll do my best to help you. Question number 9, what is the refund policy? As with all my services, I offer a 7-day refund policy in case you change your mind. So you can get into the members area, check it all out. I'll be sending out the first monthly report within the first 7 days. And so you can try it out risk-free. Just keep in mind, if you do request a refund, you won't be able to get back in at the same price. I'm only offering a 40% discount for launch week only. Then I'll never be offering a big discount like that again. And I have had a few people in the past get cold feet shortly after joining. Request a refund only to regret it later once they see my results. And I've actually had a couple rejoin. And lastly, question 10, what happens if too many people follow this strategy? So 2 things. First, I'm only investing in high liquidity ETFs that trade millions of dollars worth of units each day with tight spreads. And I'll be buying the ETFs the day after I send them out to members at a random time, anywhere between the open and the close, to avoid crowd slippage. But second, I'll be closely monitoring liquidity and slippage. And if I think that's becoming an issue, I will close this service to new members. And so the point of this service is to demonstrate a successful strategy over time, where you can learn by following me as we navigate the inevitable ups and downs together for many more years to come. This strategy is literally how I'm protecting and growing my own family's wealth. So I'm 100% committed to successfully running this strategy for many more years to come. And I invite you to join me on this journey. This Thursday, when I open the doors just after market close, keep an eye on your email inbox as I'll be sending out the coupon code you can use to save 40% to access my new ETF portfolio service or get a package deal if you also want to get access to my stock picks and options trading chat room as well. I'll show you the latest results for how my options trading is going in tomorrow's daily market review. Come back for that one, as we've been doing very well. And also, if you want to get access to all of my custom trading view indicators, you can save 40% off with a package that includes them as well. So stay tuned in for that. I'm super excited to start this new ETF portfolio next week on the 1st of October. I'll be buying 10 ETFs and letting you know the day before exactly what ETFs I'll be buying, like I'll be doing on the first trading day of every month. And just wrapping up the daily market review today, looking at a few interesting things. Interesting to see the Major League Baseball Committee give the green light to a robotic challenge system, the first sign that robotic umpires are coming for sports. Again, I think it's inevitable. Of course, it's very early days. It's going to take a few years, but industry by industry, robots are coming. And that's a secular trend that could last another 20, 30 years. And like baseball, robots will only work to make the game and industries more efficient. And just getting back into the charts, what I alluded to at the start of this video, forgotten hot sector showing signs of making a comeback today. 3D printing with stocks like Nano Dimension, Materialize, Stratasys, an old favorite from quite a few years back, 3D Systems Corp, ticker Triple D, up over 12% today on big volume. And yes, there is an ETF for that. The 3D printing ETF under the ticker PRNT, print, very small, 75 million assets under management, given exposure to 49 different companies from around the world involved in 3D printing. And just going out to a monthly chart on this ETF, kind of similar to some of these clean energy sectors that have been beaten down, developing a long base for a few years, close to breaking out here. Kind of reminds me of a similar setup a few months back to the lithium and battery technology ETF. Was in a multi-year bear market, had a pretty good base, broke above the downward trend line, and has been significantly outperforming the last few months. But like I said, we're a little stretched here in the short term. Looking at the AI trade, 5 consecutive reversal signals, bit of a pullback, some bearish candles out there today. As I said last week, we could be in for a bit of a pullback consolidation this week. It would be quite healthy. Things have been running up pretty hard the last few weeks. Could be time for a bit of a breather. We do have PCE inflation data coming out on Friday. Be the next economic data print the market keys off. And crypto, still a little soft here as well, underneath the 50-day VWAP. And we saw it last week on the sector breadth table. Energy was coming back. Also seen utility perk up there today, as they've been a great trade the last couple of years, both defensive and offensive, as electricity is another way to play the AI boom, in addition to uranium and nuclear. So the last few times we've got a bunch of reversal signals. We have had a bit of a softness or pullback in the market. Can get a 2, 3, 4, even 5% pullback within an uptrend. Jay Powell did come out dovish and say more rate cuts are coming, but he also poured cool water, directly saying the stock market is overvalued. Maybe he doesn't want his rate cuts to continue lighting up risk assets. But the Russell 2000 small cap index doesn't have any reversal signals yet, just the major indices, which again underperformed the Russell today, as the spread between the Russell and the S&P continues to hold above the 200-day MA. So we'll see what the rest of the week brings us going into PCE inflation on Friday. Otherwise, tomorrow's the last day before I open my ETF portfolio service right after market close on Thursday. Keep an eye on your inbox or come back to the Click Capital channel on Thursday night and I'll be sharing with you the coupon code you can use to save 40%. It's a great time to be a momentum investor. The portfolio has been performing really well and I'm super excited to share it with you guys starting this week. That's all for today. My name's Jared and I'll be back again this time tomorrow. Cheers.